Paul, thanks for sharing your Wednesday morning with us. I'm wondering how reliable these inventory levels are considering some of the recently resolved issues we've been hearing about related to the Houston shipping canal, everything from fires to contaminations. One would think this could skew the numbers some, as it was a bit of a distribution constraint to begin the month off.
No, that's true. But if you take a look at the weekly numbers, there's been huge misses on both sides, both on the upside as well as the downside. What we're seeing in general, though, is we're seeing building in inventory. We're seeing it across the board. We're seeing levels that we are better than they were a year ago as far as inventory levels. And production still continues to be pretty strong here in the United States. So our anticipation is we're probably going to be topping out around that 70, and I think that's probably going to be a good ceiling for crude at this point. We've backed off a little bit. Seasonally speaking, at least from the pump perspective, we should be topping out this week, last week, or maybe even next week, and we should see pump prices kind of flatten out to maybe even trend downward as we get through the summer driving months.
Paul, yesterday the OECD, that's the Organization for Economic Cooperation and Development, revised their growth forecast lower again. I'd imagine this isn't helping the crude bulls much either.
No, it's not, and we're seeing it in the United States. We're seeing it around the world, certainly as the trade talks continue or don't continue between the U.S. and China. The risks, I think, for the global economy and the U.S. economy are on the downside, and we would expect demand to fall off here a little bit. Again, we've been seeing demand generally slow down. One of the things that we track is miles driven here in the United States. That's actually been coming down on a year-over-year basis as well. So we're not looking at a big ramp up here in demand for crude, and part of the reason why we've seen it flattish over the last 3-4 months, even as we see rig counts come down here a little bit, production's still well above normal here.
So, Paul, when talking reasons for the energies coming off some this week, this month, there are many. The dollar's one. It continues to hold near the highs of the year.
No, that's true, and the dollar, I think, has really been the safe haven. I mean, when we've talked about it in the past as far as what the safe haven trades are, it's the dollar and it's treasuries. So as we get the markets pretty volatile here over the last 2-3 weeks, the flight to quality has been the flight to treasuries, flight to the U.S. dollar. We're seeing a little bit in gold, and as you highlighted earlier, it's a little bit of a surprise that gold's picked up here a little bit, even in the face of a stronger dollar. But I think one of the drawbacks, if you will, or one of the commodities that's hurt is energy because of that stronger dollar. And as you know, energy trades in U.S. dollars around the world.
Yeah, you know, Paul, that's definitely one of the bearish factors, or one of the things that's been kind of keeping a lid on crude. But I'm hearing the U.S. gasoline and distillate supplies have slipped below average. I'm hearing about floating storage at 3-year lows with U.S. consumer confidence strong and a tight labor market. But now I think of all that, and it could change quickly if demand concerns become more than just concerns.
No, that's true, and you're right. You know, it's one of the things that we take a look at is the consumer confidence. But I think, you know, again, from a sentiment perspective, consumers are still pretty confident. But if you take a look at what are they doing, and that's where we see it in retail sales numbers and spending, they're not spending like they used to, and they've pulled it in a little bit. They're not extending credit as much as possible. So when you look at year-over-year levels of consumer credit, it's not up as much as you would expect, given a very positive jobs picture and confidence that's fairly high. So again, I think the global backdrop and the U.S. consumer may be stepping back here a little bit, cause for concern for crude prices, at least in the near term.
So, Paul, normally when we wait for the FOMC minutes, so there's a lot of focus on the financials, the treasuries, the currencies, but I'm wondering what kind of an impact would you think we're going to see today in terms of the energies?
I'm not sure we'll get much in the way of energy. I think there's going to be some commentary around inflation. Inflation has picked up a little bit. A lot of that is due to the fact that energy is up from, you know, the low 40s to the mid 60s over the last 6 months or so. But again, on that big word, I think that we're going to be looking at from the inflation side is transitory. And I think we're going to be seeing that inflation push to the high side, transitory. We've heard from some of the federal Fed officials and regional governors that they're looking at inflation turning down here a little bit and certainly fueling and stoking the fires for a rate cut later this year.
How about rates, Paul? Because I just pulled up a kind of a longer term chart, and I'm looking at rates throughout 2016, 2017, and, well, a little bit of a disconnect here in 2018 as rates came off. But for the most part, rates and crude have been following each other very closely. I mean, I'm wondering if some of the price or some of the decay that we've seen in rates in terms of the 5-year yields, a new low last week, if that's a reflection of, well, can we expect crude to come off now a bit as well?
Yeah, and it's true. We've gotten prices and rates moving up a little bit as the Fed got a little bit more aggressive. They pivoted out of that in January. Crude prices continued to rise in the first quarter and have come off here a little bit. And I think maybe if we lag that a little bit, you might be able to say, okay, if rates are coming off, it's only because of weaker economic data. But I think there's another key to this in the fact that the Fed is also still in play and still very willing to tweak interest rates. And I think they may be willing to push them lower if the economic data comes out a little bit weaker than expected. So I think we're seeing, at least in the short run, and historically that's not been the case, but in the short run I do think crude prices are following yields a little bit here.
Okay, Paul, a minute ago you briefly mentioned gold related to the dollar, but I'm wondering how much do you think we can equate or tie the weakness that we've been seeing in the industrial metals like silver and copper, both into new lows for the month this week? How much can we tie this to the energy products? Are metals potentially telling us that the U.S. energy demand story, well, telling us the story that we don't want to hear?
Yeah, no, that's very true, and that's one of the big disconnects even in the equity markets. We've seen the Dr. Copper come off significantly, silver coming down as well. And we've seen it in some of the regional manufacturers, regional Fed data, manufacturing, the ISM data. They're generally a little bit weaker. And so we would expect to see that filter through to energy at some point. So I think the risks for energy are more on the downside than the upside here, and that's part of the reason why we're saying a cap probably at $70 is going to be good, and we may get down into the 50s over the next 6 months or so. Again, I think the risks on the equities are on the crude side on the downside here.